The Income Tax Act 2025. Today is day 39, and I'm studying a few sections relating to the taxation of partnership firms, starting with section 35E IV. This is about the limitation on amount of interest we can give to a partner. So it deals with various cases about whether partner is in individual capacity or representative capacity. So let's understand this. It says that whenever we give interest to a partner who is both either partner on individual capacity and interest is received on individual capacity, then the limit of 12% as in section 35E applies. Or if he is both partner in representative capacity and receives interest in representative capacity only, then again the limit of 12% interest applies. But in case he is a partner in individual capacity but he is providing a loan in representative capacity, then he can charge more than 12% rate of interest. There is no limit for the rate of interest here. An example is this is a firm in which Mr. BB is partner. If he is a partner in individual capacity and he normally provides a loan, then the interest he receives on it will be maximum 12%. But when he is a partner in individual capacity and he does not have funds to give loan to the firm, so he asks Mrs. GF, an outsider to the firm, to lend him some money so he can lend it to the firm. So he provides the loan on the representative capacity to the firm. He's a partner in individual capacity, but he's not providing loans from his own pocket. He's providing it from someone else. He's just being a representative of someone else. So he is receiving interest on it in a representative capacity only. So here the interest of 12% will not be allowed, will not apply, and more than 12% will be allowed as deduction. Same is the case when a partner is a partner in representative capacity, but he provides a loan in individual capacity. In this case, also there will be no limit on the rate of interest. An example is this HUF is the partner of this firm, but it's not directly its partner. It has kept Mr. BB as a representative of the HUF to be the partner of the firm. So Mr. BB himself is not the partner of the firm. HUF is the partner of the firm. Mr. BB is just a representative on behalf of the HUF, he is the representative capacity partner. And now what he does, Mr. BB, out of his own pocket, his individual funds, he provides some loan to the firm. Since in essence Mr. BB is an outsider to the firm, the interest he received on this loan, there will be no maximum limit. That means he can receive more than 12% of interest on such loan. So when we have to check the limit of 12%, we have to keep in mind it only applies when a partner is both partner in individual capacity and receives interest in individual capacity, or he is both representative capacity partner and receiving interest on representative capacity only. If there is these alternate cases where he is partner of one type and receives interest in other capacity, then there will be no limit on the amount of interest. He can even receive 50%. It doesn't matter. It's between the firm and that person. There's a note here which says that this is only applicable for interest. It's not for the remuneration part. Then there is interest on drawings. When a partner gives interest on drawings to the firms, it's taxable as PGBP income, and it is not set off with the interest on capital. Means we have to show complete. If this is the profit and loss account, partner gives, let's say, 10,000 interest on drawing to the firm, and the firm pays interest on capital of 7,000 to the partner, then we don't set off this and write 3,000 only. We write both amounts. We have to write this separately, interest on drawing, and make it taxable as PGBP income. That is all about this section. Moving on to the next section, which is section 1191, which is regarding the carry forward and set off of losses. Here the losses, it does not only include business loss, it means any loss, means capital loss or loss from any other head of income, other sources loss will also be counted here, or house property loss as well. There is no loss in salary head, so that's not relevant. It says that the losses and unabsorbed depreciation can be carried forward by the firm only. In case of either the partner retires or the partner dies, the firm shall not carry forward his share of losses. The partner who retired and the partner who died. that share of loss will lapse for the firm. They cannot utilize that in future years then. But we have to first adjust it with current year profit for the duration he was a partner in the firm. This will be clear in an example soon. Section 1191 does not apply to unabsorbed depreciation, which it means that even if some partner retires or something, then the firm will still be able to claim unabsorbed depreciations. It will not lapse. Then comes the case of legal hire. If he becomes a partner after death of any partner, then firm can carry forward and set off losses. This is the case of legal hire. Explaining it in a more simple language, we say if any person incurs any loss, only that person can set off the loss. In our case, it's partnership firm. But there is an exception to this rule. In case of amalgamation of firm, they can continue to carry forward and set off losses. In case of demerger and in case of succession, with succession, the one we covered earlier about proprietorship converting into company, firm converting into company, or company converting into LLP, these kind of succession, it is allowed to carry forward losses and set them off in the future. And there is that case of change in constitution of firm which I studied earlier, where some partner continues to remain a partner in the firm, and there is, it's not called as succession, as in ABC is not becoming XYZ. That kind of partner, that kind of change in constitution, in that case also they'll be able to carry forward the losses. So what some people might do, some people would think that if we directly convert ABC to XYZ, this will become succession, this will become kind of complete resolution of the firm. So they thought, why would we convert directly from ABC to XYZ? We should convert it in steps. Like we first retire Mr. C and bring in Mr. X, then retire Mr. B, bring in Mr. Y, then retire Mr. A and bring in Mr. Z, and then it gets converted automatically and without complete succession of the firm. It gets completed in steps. That is why this rule is here, which says retirement of partner, his share lapses. This is an example. When a partner is retires or dies, then his share in that firm is not allowed to be set off or carried forward. This is an example where ABC is a partnership having three partners, A, B, and C, and it has brought forward losses amounting to rupees 9 crore rupees. Assuming they have equal share in the firm, each partner has rupees 3 crores brought forward losses in the firm. So what they do, they decide to convert it into XYZ, but in steps. So first Mr. C retires and Mr. X joins the firm. They thought that they can set off complete 9 crore after that, but it's not allowed because of this section 1191. So Mr. C share, which will be rupees 3 crore rupees, will lapse, and the new firm ABX will only be able to set off 6 crore losses. Similarly, when Mr. B retires, his share will also lapse. The new firm AXY will be able to set off only 3 crore, which is A's share only. Then again, when A retires, the complete share of all three partner lapses. So there is nothing to be set off on behalf of those partners. Again, this is those two cases. It does not apply to unabsorbed depreciation and legal heirs case. Then there is some play that people might do. Like this is an example where in tax year 24-25, ABC were equal partners and they had a combined loss of 9 crore which they were carrying forward, which means they each have 3 crore rupees of loss which they are carrying forward. In 26-27, Mr. C has to retire. So they thought if he retires like this, his share of rupees 3 crore will lapse. So in tax year 26-27, they first changed his profit sharing ratio to only 1%, so that only 1% of his share of losses will lapse. But this is not the case. It has been clarified that profit sharing ratio will be checked at the time of incurring of losses. So at the time of incurring of losses, which in this example is tax year 24-25, the profit sharing ratio was equal. So this loss which is being carried forward will be distributed in equal share among these partners. The later change in profit sharing ratio will not affect this, and whole of rupees 3 crore will lapse on retirement of Mr. C. Now, this is an example of the same brought forward losses rupees 8 lakh rupees. This is a partnership firm having XYZ as partners, and they have equal profit sharing ratio. Unabsorbed depreciation is 1 lakh 10,000. This will not be affected in any case, and they have profit for the current year 9 lakh 30,000. Mr. Z has decided to retire on 30th June 2026. So his share in losses would lapse. The total share is 8 lakh rupees. His share would be one third of it, which is 8 lakh divided by 3 is 2 lakh 66,667. This will lapse, but this will lapse after setting of current year profits. So in current year, how much profit would belong to Mr. Z? It can be calculated as rupees 9 lakh 30,000 divided by 3 is the share of each partner. But Mr. Z retired early. He retired in June 2026, so his share is for only 3 months. So multiplied by 3 divided by 12 gives his share of 77,500. So out of 2,66,667, after adjusting current year profits, rupees 1,89,667 will lapse, and the rest of it will be available for the remaining partners to utilize against their profits. So at the end of the year, they have a total profit of 9,30,000, and they can set off brought forward losses of rupees 8 lakh reduced by the reduced by the share of Mr. Z, which lapses this year. So 8 lakh minus 189,167 gives us 6 lakh 10,000, which they are setting off. And this gives amount 3 lakh 19,167, against which they will adjust unabsorbed depreciation. This remains unaffected due to retirement, as mentioned above. So in that way, they'll be able to set off these losses. Now there's a question which is kind of a comprehensive question. It covers many cases related to this, and it's worth a read. On 1st of April 2026, Mr. Mr. Bino Limited of Delhi is a domestic company. It gets converted into LLP. Means this is the case of succession of a unlisted public company into a LLP. This is allowed, and in this case, they are allowed to carry forward the losses, business losses. Fulfilling all the conditions under section 71 ZE. Some of the relevant information as on 31st of March 2026 is as under. This is kind of a question of PGBP chapter, but it covers various concepts at once. The first one is VRS expenditure incurred by the company during tax year 24-25 is 20 lakhs. The company was allowed deduction of 4 lakhs each for 20 tax year 24-25, 25-26 under section 52. So this is a deduction which a company can claim under section 52 for 5 years for the VRS expenditure they incur, and in case of succession they can continue to claim such expenditure. So this rupees 4 lakh will also be allowed in tax year 26-27. Is tax year 26? Yes, 26-27 tax year. This rupees 4 lakh will also be allowed to be reduced from the profit of the firm in tax year 26-27. Now there is some information given about the shares which were purchased by Bino Limited. These have been purchased for 1900 on 31/7/2017. This point will become relevant in a second. And then there is this point. Besides other asset, Mr. Somya Bino, it also transferred 2 factory buildings, which were transferred from the public company to the LLP. Out of these 2 buildings, one factory building, along with plant and machinery and furniture, was rented out at a lease rent of rupees 50,000 per month. So this income would be the income from lease, and it will not be included under PGBP head. It will be included under IFOS head, income from other sources head, and any expenditure relating to this income will be adjusted in that head only. It will not affect the net profits of the firm or the book profits. So during the tax year, the Somya LLP earned a profit of rupees 25 lakh 40,000. 25 lakh 40,000 after debit credit of following items. This is the profit figure which Somya LLP has reached to, but we have to check the book profits of the company so that we can calculate the amount of remuneration allowed to the firm and make any adjustments that are needed to come at a correct PGBP figure. So these are all the adjustments that we have to make, but before that we have to check the items which have not been adjusted in this 25 lakh 40,000. It has not it has been arrived at without considering the VRS expenditure which will be allowed to the firm. So we'll reduce 4 lakh from 25 lakh 40,000 because this is an expenditure which is allowed to the LLP. Similarly, this will not affect this income of rupees 50,000 will not affect our net profits because it is not included in this net profit figure. Now, starting with each adjustment, let's start with the first one. Mr. Binu is the working partner of LLP. He is also working partner in another firm. It does not matter how many firms you are a working partner is. You are a working partner, but as long as you are a working partner, you are entitled for remuneration if the partnership deed allows so. He is actively engaged in both the firms. Binu gets a salary of 55,000 per month from Somya LLP, and the same is authorized in the deed of LLP. So the amount of remuneration we have to check as per the book profits, how much remuneration the LLP can pay. For that, for the purpose of calculating the book profits, we have to first add this back to the net profit. So this will be added back. And then later on, after checking the limit of remuneration, we can reduce it from the book profits to arrive at PGBP figure. That will be taxable. Ayushman, next adjustment. Ayushman, an employee, was deputed to work in a client's office in Mumbai for 3 months. The LLP has paid salary in cash for the months he was in Mumbai, amounting to 3,45,000 after TDS, since he does not have a bank account in Mumbai. The regulation of section 36 where it disallows payment of more than 10,000 in cash does not apply here because this is an exceptional case when he works temporarily on some other place for more than 15 days and he does not have a bank account there. In that case, the salary is allowed to be paid in cash, so there is no adjustment required to be done here. It's slightly reduced from the income to arrive at profit figure. Amount of 25,000 being paid for penalty of non-fulfillment of delivery. This kind of penalty is allowed to as deduction. Only penalty on income tax or GST is not allowed. That's why we have no adjustment to be. There is no adjustment to be done in this case also, because these are all the figures which have been either reduced or added to the income figure. Therefore, this has been already reduced, so we will not do any further adjustment for this. The LLP has provided an amount of 18 lakhs being the sum estimated as payable to workers based on agreement towards workers' periodical wage revision in months. If the provision is based on fair estimation of wage and reasonable certainty revision once in, since it's based on fair estimation of wage and reasonable certainty is it will be allowed as expenditure, so we don't need to do any adjustment in this as well. Depreciation debited to P&L account is 5,40,000. This will be added back to the profit and loss account. Because this is the book depreciation as per books of accounts of the LLP, not as per income tax act. We'll later reduce the income tax depreciation from this figure. Then there is gratuity provisions based on actuarial valuations, rupees 6.5 lakhs. And actually, gratuity actually paid was only 4 lakh rupees. It doesn't matter even if the president gives the valuation of the gratuity, we cannot reduce any provision of gratuity. We can only reduce the gratuity actually paid, which is rupees 4 lakh. So the difference rupees 6.5 lakhs minus 4 lakhs, which is 2.5 lakhs, will be added back to the figure, and it will not be allowed as expenditure. Then comes profit from sale of shares of MS Toyo, rupees 1,27,500. These shares have been sold on 31/5/2026 for 27.50 per share. The highest price of Toyo on stock exchange was rupees 2,500 per share as on 31/1/2018. This is the case of grandfathering rule. Firstly, all the things related to this will go in capital gains head, PGBP head. So the profit on sale of shares of Toyo rupees 1,27,500. This has been added in the income to come at net profit. So this will be added back. This will be reduced from the figure because it does not come under PGBP head. It comes under capital gains head. So for the purpose of calculating capital gains, we will have to first see the FVOC. FVOC. FVOC will be rupees 2750 and number of shares was 150 shares. So 2750 will be FVOC, and for the purpose of calculation of cost of acquisition, the grandfathering rule will apply, which I have studied earlier. It says the cost of acquisition will be, first we'll check the lower of these two, FMV as on either the FMV as on 31/1/2018 or the selling price. So in this case, FMV is 2500 and selling price is 2750. So lower of these two is 2500. Then we'll compare it with the actual cost of shares, which in this case is 1900, and the higher of these figures will be taken as cost of acquisition. So in this case, the cost of acquisition is 2500. This gives us a profit of 2750 minus 2500, 250 per share. 250 per share, and there are 150 shares in total. It was mentioned above in the question. So our capital gains income would be rupees 37,500. This will go under capital gains head, and it will not affect the PGBP head. Only this figure was already added in PGBP head, so we reduced it from the income. Then we have repairs to plant and machinery include 59,000 in respect of plant and machinery given on lease. Since lease goes into IFOS head, all the expenditure will also go there. So we'll add back this expenditure as well. Then there is factory license fee paid 15,000 for each factory building. So there were two factory buildings, one of which we gave on lease. The factory building which we continue to own and use for ourselves, will be allowed to claim the expenditure on factory license on such building. But the other building which we gave on lease, we have to adjust this expenditure in IFOS head only. So we'll add back rupees 15,000 in IFOS head, and the lease of other building which we continue to own rupees 15,000 will be allowed as deduction. So there will be no adjustment for that. Only 15,000 should be added back. Then there is legal fees 26,000 paid to an advocate for drafting and registering the lease agreement. Again, it is regarding that leased building, and it will affect the IFOS head, and it will be added back in the profits to arrive at book profit figure. Then there is this. Under an agreement of debt restructuring, bank has converted unpaid interest amounting to 9 lakh rupees into a new loan repayable in 3 equal annual installments. First installment was paid in March 2027, which means 9 lakh has to be paid in 3 installments, 3 lakh each year. First installment of 3 lakh has been paid in March 2027. This is the case of conversion of interest in other firms, but is still considered as payment of interest. So the amount of 3 lakh which the firm has paid this year will be considered as interest expense for the firm, and it will be reduced from the net profit figure. This is additional information, so these adjustments haven't been made to the figure above. So we'll be reducing this rupees 3 lakhs from the above figure to arrive at book profit. Mr. Binu is a working partner. A car has been registered in his own name, but is used exclusively for the purpose of business. Substance matters over forms. So any expenditure on such car will be allowed to the firm. The depreciation on the car amounts to 15,000. This will be allowed as deduction, so we can reduce it. Then there is depreciation as per income tax rules, 8,10,000, but it includes depreciation on the leased factory of rupees 90,000. So we'll reduce 90,000 from this, which gives us 8,10,000 minus 90,000 is 7,20,000 can be allowed as deduction. Will be allowed as deduction for the business. It does not include depreciation on car. That's why I reduced it here only. The LLP sold import entitlement on 1/5/2026 for 1,50,000. I studied this in the charging section only, that this is added in the PGBP income. So we will add this. These are all the adjustments we need to do, which give us a book profit figure of rupees. After all these adjustments, we arrive at this figure, rupees 26,77,500. This is our book profit. And then we check the limit as per section 35E, if we are allowed to pay remuneration to our partner, how much we are allowed. So in this case, we have a sufficient margin. Rupees 17 lakh 86,500 would be allowed to be paid as remuneration, but we are only paying 6 lakh 60,000, so we can reduce it from our book profits. So this gives us a final PGBP figure of rupees 20 lakh. Then similarly, capital gain of 37,500 and income from other sources. It includes all the incomes and expenditures related to the leased building, which are allowed here. This is the income and these are the expenditure relating to it. This gives us a IFRS figure of 4 lakh 10,000 and total income is 24 lakh 65.